Hi, I'm Jo Elwell and I'm joined today by Kelly Kilpin. So we work for Brookson Financial as part of the management team here, and we specialise in helping recruiters obtain their mortgages. So what we want to do today is we've just put together a really short sort of 5-minute video to give you some hints and tips that we think you might find useful if you're considering a mortgage in the near future. So first of all, what challenges are we faced with when helping recruiters? So it's quite common that a recruiter will receive a basic salary and then be paid quite a high commission as part of the remuneration package. And some high street lenders are really strict when looking at this and assessing the income. So if you do receive a large proportion of your income through commission or bonus or even overtime, you may have struggled to actually get a mortgage in the past. So Kelly, can you just tell us a little bit about how the lenders do assess commission, please?
Yeah, absolutely. So different lenders have different considerations that they will accept, especially when regards to commission income. Some will take monthly commission, some will take quarterly, and some will take annual bonuses. They're all calculated in different ways as well. So it really is absolutely vital to ensure that the timing of that commission is known to your advisors before you apply for the mortgages, because it can seriously impact the amount they will lend to you. You don't want to get too far down the process and have the wrong information at hand.
Yeah, and that's why we really do recommend that you do seek a mortgage broker who is whole of market as well, because they should be able to understand which lenders they need to approach that will or won't use commission. So to really understand your individual circumstances, to make sure they're going to the lender that's going to provide you with the best outcome. The thing is as well, if you do approach the lenders directly yourselves and then they do decline or that you can't get the mortgage that you want, that's actually going to impact your credit score. So if you then go to a broker and they approach the right lender, you might get declined just based on the amount of credit checks that you've had. So that's why we really do recommend seeking out a broker. So we actually have access to high street lenders that will use 100% of consistent commission, or even if your commission fluctuates, they'll use 65% of your commission as well. But what we can actually do is talk to the underwriters. We've got access to the underwriters of the lenders before we submit any case. So this avoids us doing any unnecessary credit checks on you before actually knowing that we've got a good chance that your application is going to be approved. So Kelly, could you just tell us a little bit more about that measure of income calculation?
Yeah, absolutely. So quite typically you'll hear banded around that you can have a mortgage for 4 times your income. We would say that we'd get usually around 4.45 times your salary. So we've got 2 different types of ways that the commission can be paid. We've got consistent commission and we've got fluctuating commission. So consistent commission means that you get every single month as the same amount of commission on top of your basic salary. So we have an example here of a £25,000 basic salary plus a £2,000 every month consistent commission being paid. Now, usually with consistent commission, 100% of that commission will be classified as your income. So that is added together with your basic salary. This example gives £49,000 a year. 4.4 times your income would give you approximately £218,000 as a mortgage amount. Now let's take somebody with fluctuating commission. So exactly the same basic salary of 25,000, but let's say one month you've got £2,000 commission, the following month £500 commission, and then the following month after that £1,500. Let's calculate that out annually. Now, because it's fluctuating commission, the lenders will notoriously only allow you to use 65% of that commission income. So that calculates out on our example to be 16,000. Add that onto the basic salary of 25 gives you an income of 35,400. Multiply that by the 4.45 times income and you would get approximately 158,000. So you can see how the difference between whether it's a fluctuating commission or consistent commission really affects the total amount you can borrow. I do also have here an example on an annual commission. So this is the basic salary based at £40,000 with an annual bonus of 30,000. Some lenders will take an annual bonus, but usually and typically that's at 65% of that amount. That could then generate a mortgage of, in this example, £265,000. So again, as Jo said earlier, it's absolutely imperative to seek out a financial advisor who specialises in people who are receiving a basic salary with commission to ensure that you have a smooth process right from the very beginning.
Yeah, I just think just to add to that as well, Kelly, it's really around how your case is presented to the underwriters. You know, if we've got a good case, we can look at things like your P60s, your last 3 months pay slips. It's really getting a good understanding of your affordability and how we present that to a lender. And that's why I can't stress enough, you know, to really get a broker who understands the needs of a recruiter. So just in summary then, and just a few more sort of hints and tips if you are thinking about buying a property anytime soon or remortgaging, it's really vital to make sure you are on the electoral roll. So all lenders now will be doing credit checks to make sure they've got at least a 3-year trace to make sure you're on that electoral roll, and you're aware of your credit history as well. There's companies out there like mobile phone companies. They can put sort of non-payments without you even knowing on your credit history. So just get a copy of your credit report and just make sure that, you know, you're aware of anything that's on there. Then also have a little check of your bank statements. Does what you're earning stack up against what you're spending? Because that's what the banks are going to be looking at. You know, if you've got going out each month more than you've got coming in, that's going to have a warning sign. So have a look at your own bank statements. Would you lend money to yourself? And start to think of it as if you were the lender. As we said before, avoid unnecessary credit checks, because there are some lenders out there that won't even just consider a case. It will just be a computer says no based on your credit score. So even things like Money Supermarket, when you're shopping around for your insurance, they can be doing checks in the background that you might not even be aware of. So that's just one to watch out for. And then I think the theme has been the same throughout this whole presentation. Use a whole of market mortgage broker to ensure they specialise in sourcing mortgages for the employees who do earn bonus and commission as part of the remuneration package. And then the other thing as well, with it being in the news at the moment that rates are likely to start creeping up next year, just want to make you aware, if you're within 6 months of your mortgage end date, you can actually start sourcing a mortgage now. You don't need to wait till the last minute. So if you've got a mortgage coming to the end within the next 6 months, start looking around now while, you know, the rates are as competitive as they are. Okay, so thank you. I hope you found that of interest or of some use, and we're here to help any recruiters if they need some help or advice with their mortgage needs. So thank you for listening.
Thank you.